Welcome everyone, happy Thursday. Thank you so much for taking the time to join today's webinar. We're going to be talking about multifamily investing inside of your IRA. It is top of the hour and I do want to be respectful of everyone's time, so we're going to go ahead and get started. I'm Reneika Lightbourne with Advanta IRA, and I am delighted to be joined by two very special guests. We have Kaylee McMahon, she's the founder and general partner from the Apartment Queen, and Joe Pizzurro, the managing director of BreakChain Capital Investments. Thank you both.
Thank you for having us.
Thanks, Renika.
Absolutely. So Kaylee and Joe will cover some of the smart multifamily investment strategies that they've implemented in their investment journey, like improving cash flow without having to do any significant renovations. But before I turn it over, I just want to give you a general high-level overview of what self-direction is, how to get started with us, and just a little background about Advanta and who we are. If you have questions, feel free to type those questions in the question box. We will allocate some time at the very end to get those answered for you. Also, too, just know that this webinar is being recorded, so you will have access to the recording within 24 to 48 hours. Again, I'm Renika Lightbourne. I'm one of the business development specialists here at Advanta. I've been with Advanta as an employee since 2019, but I'm also an Advanta client prior to joining the staff. So self-direction is something that I actively do, something I highly encourage both personally and professionally. If you have any specific questions or you want to talk through your scenario, feel free to give me a call, send me an email, or you can visit advantaira.com to schedule a consultation. So just a little housekeeping before we get started. Just know at Advanta, we don't give any tax, legal, or investment advice. We also don't endorse any particular products or service. Just know that the information that's going to be presented today is educational purposes. So as always, we encourage you to do your due diligence, confer with your professional team, whether it's your CPA or attorney or financial advisor, before making any investments. So just quick takeaways in terms of when it comes to self-direction, if this is a new concept for you. Just know that any IRA or former employer plan qualifies to be self-directed. 2, when it comes to self-direction, you're in control. You get to decide exactly what is it that you want to invest in. Kaylee and Joe will be focusing specifically on multifamily. So if that's something that appeals to you, you can certainly use IRA funds to do so. 3, all of the income and the expenses related to that investment flows back into the IRA or is paid by the IRA. So just a little history about Advanta and who we are. We've been in the business for 20 plus years now as one of the leading self-directed IRA administrators in the business. While we don't give any tax, legal, or investment advice, our team is comprised of attorneys and certified IRA service professionals. Our headquarters is located in Largo, Florida, which is the Tampa Bay area. Advanta also has an office in Atlanta, which is where I'm personally based, but we do work with clients nationwide. We have a little over $2.5 billion under our administration. One of the things that we take great pride in at Advanta is providing you, our clients, high quality concierge style service. This is where you have a dedicated account manager who's going to be with you for the life of your account with us when you're ready to make an investment. And then of course our educational platform, where it actually features guest speakers and experts and practitioners such as Joe and Kaylee to knowledge share with you when it comes to different opportunities that you can do within your IRA. As mentioned, this webinar is recorded. You can access it on our video library or on our YouTube channel. I would also encourage you to take a look at our events page, go to our website, take a look at the events page to see upcoming webinars that we have. Also too, you can specifically request if you have a topic in mind, you can request that we can have an expert come in and knowledge share with you. Also, check out our blogs, check out our podcast that's hosted by my colleague Alex Perney. So there's a great appetite in terms of knowledge and resources out there that we provide to you. So exactly what is a self-directed IRA? It's very simply in that you as the account owner, you're going to have complete control over your retirement funds. You have complete control over the investment opportunities. You get to essentially diversify outside of the traditional stocks and bonds. You can elect to use IRA funds to invest in real estate. Specifically, we're talking about multifamily today. You can do fix and flip projects. You can invest in notes and mortgages. You can act as a private lender. Essentially, it's near limitless in terms of what's on the table for you when it comes to self-directing your IRA funds. So a common question I typically get is, why do people choose to self-direct? You can look to self-direct for many different reasons. I'll just touch on 3 of them. One, it can be a new source of capital for you. So if you have funds sitting idle in an IRA or sitting in an old employer plan, like an old 401k, instead of taking out a bank loan or tapping into your rainy day fund, you can elect to, move some or, all of those funds, like an IRA, old 401k to make your next investment. 2, the ups and downs in the stock market. We know something overseas can impact the stock market here, but a lot of our clients typically use IRA funds to diversify and invest in real estate, multifamily included, to kind of hedge against something that's happening in the stock market. We know with real estate, it's a tangible asset. It's always going to retain some value. Someone's always going to need a place to live. So if it's a rental property, or in this case, an apartment complex. And then, of course, the tax benefits. Having those rents, those profits, those dividends flow back into your IRA, tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, it is the ones that you're already familiar with. For individuals, you can look to self-direct a traditional IRA, which is pre-tax dollars, meaning you get a tax break up front. You grow your account over time. Once you reach retirement age, which is 59 and a half, you take funds out, that's when you pay taxes. Whereas with a Roth IRA, you elected to pay taxes up front, grow that account over time. As long as you've had that Roth account for 5 years and you're 59 and a half, then your distributions will be tax-free. If you are self-employed, have your own business or a side business, you can look to self-direct a SEP, simple or solo 401ks. I know a lot of real estate investors like yourself on this call like the solo 401k just because it gives you greater flexibility. It gives you the option to make higher contribution limits. You're not subject to UDFI tax with a solo 401k, and also you do have some added benefits. If you want to know more specifically about the solo 401k, don't hesitate to reach out to me to schedule a consultation to talk more about that. Some lesser accounts that can also be self-directed, but is just as important, are educational savings account. So if you have children, grandchildren, or medical care costs, we know the cost of medical care is going up. So if you have a high deductible plan, you can look to self-direct an HSA. Just check again with your plan provider to ensure that you're eligible. And then, of course, any former employer plan. Former employer plan includes 401k, 403b, TSP type plan. So as long as it's a former employer plan, you can elect to move those funds. The only thing to keep in mind is if it's a current employer plan and you're not yet 59 and a half, then most times there's a restriction in terms of you moving those funds. You can certainly check with your employer or the plan administrator to see if they'll make an exception if you are, still employed there and you're not 59 and a half. If it's an old job, you can move it at will. For contributions for 2023, if you have a traditional or Roth IRA, if you're under the age of 50, you can contribute $6,500 as long as you have earned income. If you're over the age of 50, you can put in an additional $1,000, so taking it to $7,500. For a SEP IRA, you can contribute up to 25% of your earned income, not to exceed $66,000. With a solo 401k, you essentially get to contribute twice. You get to contribute as an employee, but also you get to match as the employer. As the employer, you can possibly match up to 25%. So in this case, $66,500. For ESAs, you can put in $2,000 per year per child. For an HSA, again, check to see if you have a high deductible plan. For individuals, you can put in $3,850. For a family plan, you can contribute $7,750. Also to keep in mind with an HSA, if you're over the age of 55, you can contribute an additional $1,000. So the process with us to get started is pretty straightforward. We've streamlined that for you in 3 simple steps. First, fill out the application to get your account open with us. You can do it directly on our website, or one of myself or my colleagues can assist you with that, doing it via DocuSign. We can walk you through that. We'll get your account set up. We'll pair you with a dedicated account manager. Step 2 is funding your account. So you have a couple different ways you can fund your account. You can do a combination of making an annual cash contribution. As long as you're eligible, you have earned income, or you can transfer as much or as little as you want to or need to from an existing IRA. Or if you have an old employer plan, again, like a 401k, you can do a direct rollover of those funds. And then finally, step 3 is start investing. What is it that you have an interest in? Is it a syndication on multifamily related investment that you want to do, like, something that we'll hear about on a call today, or, is it a fix and flip, or is it tax lien related? You get to decide exactly what is it that you want to invest in. And with that, I'm going to go ahead and turn it over to our speakers, Kaylee and Joe. Just bear with me one moment. Let me make, I just made Joe the presenter. Kaylee, I think you both are using the same PowerPoint presentation, so.
Yep, I'll let Kaylee go first. Introduce herself.
Oh, I hate this part. Hi, I'm so excited to see all of you on here today. I think we have about 27 people on the webinar today, which is a great turnout. I'd love to know where everybody's coming in from. So later on, maybe we can talk about that. Any questions you do have for us, by the way, as we go along, please just stick those in the chat, and so we can come back to those at the end of the session. I have trademarked our company's name, The Apartment Queen, because I thought it was very special. We do like to hire, promote, and help women to learn how to build, project manage, and be able to be a big part of these multifamily acquisitions. I am considered the founder of that company. So far, we've purchased over 74 million assets under management. We've exited 4 deals so far, getting our investors a 2.8x multiple on those. We have one for sale right now, and we are selling one piece on another property, and rehabbing another half right now. So we're very active partners and managing principals of this business, and all we do is value add multifamily. Before I was in this role, I was in real estate as a leasing agent, and then as a real estate investor and broker, brokering deals for land and a whole bunch of other stuff, getting me to 3 million in sales before I transitioned into fully syndicating and deal managing or deal sponsoring these multifamily assets. And now it's a full-time syndication role or managing partner role. And so far we're looking to expand what we've built and be able to scale here in DFW. So hopefully you guys are fans of the 8th largest GDP economy on the globe, which is here in DFW. That's where we're focused on our acquisitions and making our investors cash flow, and of course the big check at the end of the deals, the appreciation. So we get you both. That is me.
And I'm Joe Pizzurro. I've been investing in apartments and self-storage facilities since 2019. Started out as just a limited partner investing passively, and then more recently have been general partner in about 3,000 units, all of them in Texas, about 40 million in assets under management. So on this topic, I do have several investors that use IRAs, and a lot of it's just educating them that that's a possibility. If sometimes we have a minimum investment to get in some of these deals, and if they don't have the minimum, they think maybe they're not able to invest, but sometimes they've got an IRA, so that money can be used. That's a mechanism for investing. And Reneika, as the expert, can probably help with some of those questions later. But yeah, we try to do value add like Kaylee does. So we tag team together. But the idea is to buy these properties, rehab them, and increase the net operating income, and which increases the value therefore, and then sell them for a profit. So we wanted to talk a little bit about how we do that. How do we increase net operating income? Kaylee, did you want to take this one?
Yeah, sure. I will. Yes. So this is essentially a case study that we have done before. I think, Joe, this is from one of your properties here in DFW. As we mentioned, we focus here in Haltom City, Texas, and it's a little bit smaller of an example than something that we are actively involved in, which is closer to 300 units. So you can only imagine the impact of the income that's being made here multiplied by, say, 3. But one thing that we can do on these properties is to be able to add bulk internet to the properties. We typically partner with a company here called Spectrum Internet, and when you have these larger properties, you can also utilize having a pre-existing relationship with them to be able to save money on the cost of the services, be able to have lower fees, certain other things like that. So being able to use properties that we've already done this exact same example of creating value or profit center here before, and being able to create more profit by having less cost using the same services on our other properties. This was an 89 unit property in Haltom City, Texas, so DFW here. And so as you can see, there is a fee that is charged per unit to be able to have the service for the residents. Now, if the residents were to go out on their own, typically they'd pay about $100 per unit for the internet service. So we're already giving them a discount at the $75 charge per unit from the property. And as you can see, there's a spread between what the cost is per unit of the actual service to us and between what we're charging the residents. So that is something that we're able to keep as income. And so there really is no upfront cost here. That's one of the pros of doing bulk internet. And so instead of it being, okay, let's look at the bump to the net operating income after expenses, there are no expenses. So this is something that's pure NOI. And when you're able to increase the NOI, for an example here, on average for about $27,000 a year at a proposed, say, 5 cap, that would be $537,000 of value created right away by just implementing this property wide. So yeah, as you can see, we make income. There's no upfront cost. It's just total income bump. And so really within a year, being able to implement this throughout all of the units that have not adopted or would be adopting bulk internet, would be able to make a large impact to our bottom line, or NOI, which again at a 5 cap creates about $500,000 in value right away.
Did you want to take this one? Oh, go ahead.
Joe, actually, I have my notes on the other one and not on here. Would you?
Yeah, so this one, so there's different types of water conservation that we do. This one in particular is a method where we can put a valve on the different water meters that directs the pressure of the water and reduces the pressure, and so saves anywhere between 5 to 30% of water savings. So in this example, we had 5 meters on the property. So this is showing what we would save over the course of 5 years. So that, similar to the other method, we would have no upfront cost to implement this, and then the vendor would take a portion of the savings for the first 3 years, and then after the third year, we would reap all the savings. So in this example, we'd be able to increase our NOI by $29,000 a year for the first 3 years, and then up to $46,000 after that, which equates to almost $1 million of value added.
No upfront cost. Isn't that amazing? So that's another profit center that we use. And then this is a possibility that we've done before. These are actually pre-existing units that were done on another property. That's why I'm saying case studies here, because we have proven that we've implemented these profit centers or ways to create profit in the past, and now we're just showing you how we're going to keep repeating that in the future. So here's another profit center, private fenced yards. So for example, if we were looking at a 200 unit property, 300 unit property, for example, and we wanted to put in 50 fenced yards, there would be CapEx, as we call it, or some kind of upfront cost to be able to put in these cedar fences. But if we were able to put in 50 fences at $50 a month, then we'd be able to make $30,000 a year, and that could change, right? So there are places in DFW where they're getting $70 for these bottom yards. It just depends on the testing that we do in the initial phases of implementing, say, 10 yards at a time. We always want to spend the least amount possible on materials and expenses, labor, etc., and we'll get the highest return on this profit center. So in this situation, if we were just charging $50 a month, we'd make $30,000 a year or $600,000 in value at a 5 cap. So that's pretty much a normal capitalization rate, cap rate for DFW here. So again, it's just another thing that within a year, we'd be able to implement this project and make another $600,000 in value without any major renovation problems. This doesn't disturb the residents. This doesn't require them to leave or have mass vacancy, which causes us to have cash flow issues. None of that is the case here with being able to implement these stained cedar fences, for an example. And we found that in the last situation or example where we did this, it was about $1,000 each for the yards. And so also the possibility that we do have after doing the testing, the larger the property is, being able to have economies of scale to get more material once we figure out, the higher fee, the right amount of yards that we'll be putting in. We may not need 50 fences. We may need 20 fences and get $70 a yard. You see what I'm saying? So economies of scale, the larger the property, we're also able to typically order materials all at once we know what we're going to charge, and then be able to save cost on the capital expense, or basically materials cost as well.
So covered parking is another option that we've implemented. In a particular property we're looking at now, the owner has already implemented some of these carports and hasn't started charging for them. So that's an opportunity we have. But typically they would cost about $1,200 or so, give or take, per spot to implement. And so these would just be like an amenity for the property. If you want a covered parking spot, you pay a little bit more of a fee. So typically we would charge something around $40 per spot. And it would be optional. So you'd have to kind of, test it out, like Kaylee mentioned on the other option. Maybe implement some of them at first, and if it works, then you maybe add more later. So, but it's another value add where, and I can't see on my screen, it's partially cut off, Kaylee, if you can see the actual numbers there of how much value that would be added.
Yeah, so what I see is that, for an example, if we just did 50 of these spots, so we are using these numbers because it's a real life example right now for us in a Dallas project we're working on. So if on that property we were able to do 50 covered parking spots at a $40 monthly premium, which is lower end but average for DFW, because of course the market has to be considered in these calculations. That's $24,000 a year, or $480,000 in value right away at a 5 cap, or you'd take the increase in your NOI and then be able to divide it by a 5 cap. And I just want to point out that this is one of my first properties that I ever did. I think it's super cool that we're able to share with you all like real case studies of real examples of what we've done. This isn't just, hey, education, but it's real life experience. We've been through quite a bit over the last, 6 years for me, going into 7. And then this was one that the two properties combined after adding all of these extra income items, different scenario years ago, right? But we were able to sell the property at 2 times what we bought it for. But it was because we were using all these little small methods that didn't require, a big amount of renovations. So proud of that. This place looked like horrible before we started.
The unit renovations. So obviously this is the largest value add. Some of these others that we've been talking about definitely help, as you can see, up to $500,000 to $1 million, value added. So the rents are our biggest push, and typically the way we increase rent is with renovations. We renovate the unit, put new flooring, new appliances, make it look nicer, attract a higher clientele. Now, sometimes we can raise rents simply because of the market is allowing for it. If the rents are far below market and below the comps, we can sometimes get some rent increases without doing any renovations. But in this example, we're looking at between 150 to 200 rent increase for the upgrades. So we went with 150 to be conservative. So potentially by doing this, we could potentially create almost over 10 million in value on renovating units. So that obviously is the largest chunk of the value add, are the rent increases. Anything to add?
We didn't want to focus on that as being our only value add strategy. And I'd say that's something that if it was me and I was looking to invest, there's a couple of standards that I would have, making sure that the property cash flows at the time of acquisition, presently and at the time of acquisition, making sure that you have absolute operational excellence between all of your sponsors, so they have a track record, they can show you how they got out of situations that they've had to deal with in the past. And then, of course, that there's multiple options in their business plan. So we're essentially going through our playbook or business plan of how you create greater profitability, because that's what will drive the profit of your investment. A lot of groups put together a plan where essentially they're just banking on the rent increases. There are some widely advertised groups on the internet that's all they kind of do. And you do have to put some amenities, improve amenities, and be able to do things for the residents so that it makes sense to get these rent bumps. So, you know, you guys saw us putting in yards. Typically we'll put in amenities that we didn't cover, like, you know, soccer fields, amenity centers, if there's a workout facility, improving that. So you do have to spend some money to be able to improve the property to really capitalize on these rent bumps. But we wanted to also showcase a lot of the other opportunities that we're currently using in our business plan to create profit centers to drive greater profitability in a very short period of time without fully just depending on the rent bumps, because things can happen, and they already are in the market, where we say, oh, units are 150 to 300 below market, and if our business plan was to aggressively get to 250 or 300 in a rent bump, that would be assuming that the market would never change it would never change the rent increases, and that's not happening with the affordability factor, with the demand for the market, depending on the influx of businesses. You know, DFW, like I mentioned earlier, is a great place to assume a higher rent bump than just keeping up with inflation at, say, 2.5%. You know, you could assume a higher, but we just wanted to show you guys so many different profit centers that we rely on to make income, and we don't just capitalize on one possibility, because sometimes it doesn't work out the way we plan, and then you don't really have a business plan to drive profitability or other options to pivot. So we're glad we're able to go through multiple different ways that we make investors money. And I don't know if you guys are adding up the amount of capital that we're creating here, but it's about $15 million, you know, assuming that it's about a 300 unit property that we're able to make in about a year for investors to be able to make more wealth for their family using their retirement accounts. And so really happy to be able to show you multiple ways that you can create value here for your investments.
So this last option is another way of creating savings. So this is more of a tax savings. So what we do when we purchase these properties is perform a cost segregation study. So we'll have a engineering firm come do a study. They'll look at the units, each floor plan, what they look like. They look at the amenities of the property, the age of the property, and they determine how to accelerate the depreciation. So there's something that was in the Tax Act in 2017 that allows for bonus depreciation. So essentially, you're able to claim depreciation upfront in the first year instead of it being spread over 27 and a half years or however long it is typically. So in this example, we had a total equity we would put in of 17 million, and we would be get about 8 million back on our tax return the first year, which is about a 47% return. The investors would get that money back in the following year. Now you do want to talk to a CPA, because there are stipulations on how that can be applied, to offset taxes, but you would be getting that back in your K1 as a loss. Anything to add, Kaylee?
No, I don't know if it says it on here, but I'm trying to remember from memory that there's just a huge difference from projects that do this and projects that don't do this, and we always do this. And we protest our taxes too. So every year we're fighting with the county that we have the property in. So this one currently we're working on is in Dallas County, to be able to also save money there as well, because that just increases the amount of cash flow that we have not paying as much in tax. But I believe it was with just regular straight line depreciation for the asset we're working on now, as an example, 300 units in DFW. It was 118,000 or so would be just regular depreciation, and then after the study, I believe it was a total over the full hold time of the asset. It was 3.4-ish million that was created from doing that study. So it does incur some upfront costs to do these studies, but we have found, especially right now, this is the last year where you can get 80% of that benefit. And the next year it drops down to 60. So we do want to spend the money and the time to do the engineer study to make that huge difference in the amount of depreciation we can give to our investors. And that is something that we do. Is if you're a shareholder, you own a percentage of the company, and depending on, well, we would be able to give investors their percentage of that benefit. So especially if you're a real estate professional, if you haven't already talked to your CPA about it, you'd be qualified to receive potentially 100% of those losses and to reduce how much of your active income that you're taxed on. And if you're a real estate professional, your spouse can also get those benefits from you if you've used everything you can. So, marrying a real estate professional or being with a real estate professional is a great benefit, especially if the projects that they're investing in are utilizing this depreciation or bonus depreciation from a cost segregation study.
And Renika, that was all we had, but we're open for questions.
Thank you both. Great information as always. I do have questions that came over. So the first one is, what was the per unit renovation cost on the apartment that increased 150 per month in rent?
About 7,500 on average. It would depend on the floor plan. Obviously, the larger units are more expensive. It would also depend if any of the units had already had some partial upgrades in it. Those would be less expensive, of course, but on average about 7,500.
In some of those units, we find that in our history of renovations that really make a direct return on your investment, I would say hard floors, or we do vinyl plank, luxury vinyl plank. Those really get a great return quickly because they make such a difference. And then kitchen and bath, of course. But in this example, some of those units, they had already done the floors, which is great because, several thousands of dollars is not something that we have to take care of. And some of them, like Joe mentioned, don't need all of the things to change, or we've been able to figure out, okay, well, this demographic of people, for example, really care about their kitchen, and they really care about having a backsplash and Formica countertops, for example, where sometimes we would do different renovations. So if they appreciate, it depends on the value that the residents place also on the types of renovations that we do, as far as what we even need to spend. So it's a little bit of testing too in the beginning. Like, you go to your property manager and you say, hey, here's our plan. Here's the units that we know, 70 of them in this example that we know is going to get our ROI back in 36 months. Great, we want to focus on those. But maybe we don't need to spend all the money that we thought we did because of the demographics or the feedback from the manager.
Okay, some more questions that came in, just bear with me. So how much is the renovation cost per door in DFW area?
I would use a little higher than that, maybe 8,500. Just this example was, we had a lot of partial upgrades, so it was lower. But I would say even like we've seen some costing over 10,000 per unit, some in the past year. So, but I would say between 85 to 10,000.
Okay.
And again, with economies of scale too, you can drive that cost down if you're able to go through. There's some supply houses here in DFW where you can order containers of supplies from different places. It takes 3 months to get here, but you're able to save sometimes up to 50% of your costs. So depending on your renovation plan, how much capital expense you have to spend, and if you're able to access all that money at one time, there's another way to be able to drive that cost down. But that's definitely if you're going to Lowe's with a pro account, and at least you're getting their kits at less of a cost, but you can still drive that cost down too if you work through a supply house and a warehouse that stores your kits.
Okay, next question is, what kind of payback period do you look for when deciding whether to undertake a particular capital improvement?
As fast as possible. I mean, truly what I normally do is look at all of the potential, okay, what's the market rent unrenovated? What's the market rent renovated? What is the amount to renovate, minimal as we can? And then really for me, it's trying to see, okay, which floor plan or floor plans, there might be one or two that really just are the ones that you're able to get that rent pop easier and faster. So 36 months-ish is what I look for, but I mean, if it's a little longer, that's okay too. Joe, what would you say?
And to add on to that, also, using when we're speaking commercial real estate, there's something to consider about the value increase. So even if you make these changes, as long as you're proving out the new rents for several months on the books, you could then sell the property and realize that value without waiting for the ROI, right? So that's something about, you know, multifamily that is different than single family. So that's also something to consider.
Okay, next question, question that came in. How do we get a copy of the content shown? So yes, feel free to reach out to me. I'll get a copy of the presentation from Joe and Kaylee, and I'll be able to share that with you. Also, too, this recording will be uploaded onto our YouTube channel, you know, later today or first thing tomorrow. So you will have access to this recording and the information presented. Next question is, do you have property management in-house or are you outsourcing?
Currently, we use third party.
Okay, so we answered that question. So the next question that came in is, how long do you hold your apartment? Is it for 5 years, 10 years? Can you elaborate?
It typically depends on the business plan. I ideally would love a longer hold, because then what we're doing is we're creating generational wealth, right? So if you were able to be in a project like the one we're working on where it cash flows all day long, 6.5% the whole hold time, you know, why would somebody want to get out of that? I don't understand. They just keep getting checks, and then every time we do exit at, say, about 5 years, then they'd be able to have that big bump at the back end. But so right now it's about 5 to 7 years, depending on the business plan. But eventually, I'd like to hold longer and be able to have legacy wealth created, not just for our team, but for our investors as well.
Yeah, and it also depends on the investors. So if the majority of your investors are looking for a shorter hold, then that obviously influences the plan. But yeah, we've done anywhere from as short as 3 to 5 years. But to Kaylee's point, you can still cash out investors through other means like a cash out refinance and get them equity back and continue to hold the property.
Okay, next question is, does your investing personality change based on market conditions? Like if it's a down market?
Yeah.
I think there's always a deal to be made. I think, you know, when the market was hot, we were overpaying for properties, but we were getting great terms from lenders. So that equation balanced out versus now we're getting a better cost basis, but the terms are not very favorable. So something that seems to work now is getting a low cost basis and then finding an assumable loan where you're still getting the terms from a few years ago. So those are ways to kind of cheat the system, so to speak. But yeah, definitely always a strategy to be found, I think.
Yeah, definitely. I agree with you, Joe, that's been what we've seen when deals work now, because, you know, a lot of the issues that we run into because of the new market and lending and whatnot, now it's not going to really get better, is negative leverage, you know, and so that doesn't really produce cash flow. And, you know, for me, I'm finding that if it was me, or if I was ending the end of my life or wanting to, say, use my retirement account, what I'd really want to use it for would be to have consistent cash flow. So if we're finding something that has a fixed interest rate, for example, for 9 years, if we have a property that doesn't, so fixed meaning that it will never need a rate cap purchase or have a rate cap that expires, rate cap reserves, or variable interest rate loans, of course, or floating rates, we're able to make sure that essentially our debt cost stays consistent, and so there aren't any surprises when it comes to changing that cash flow number. It'll stay consistent, and that way, that's the way that, yeah, we're seeing that they're working right now in this market.
Okay, next question that came in is, how can we invest with your firm? So yeah, I know you have to provide your contact information, but that's a question that just came in.
Yeah, I did stick in the chat. There's 2 links I'll give. One is to get qualified. That's important. Of course, we establish an official relationship, and then investors will know which offering you would qualify for. So I did stick a link in the chat to use or to share that's for qualification. And then the second one that I love better is being able to talk to our investors and figure out what does your retirement plan look like, how can we help you achieve it faster, how can we partner together to be able to achieve each of our goals, which would be booking a call. So that's the second link that I provided to be able to talk through, what it is that you're looking for and how we can work together. And then my contact specifically, if you'd like to email me, it's going to be apartmentqueeninvestments@protonmail.com. Joe?
And I'm putting mine in the chat right as we speak.
Okay. I'll do the same.
Okay, next question that came in, just bear with me. It says, how is the deal structured regarding profit sharing as an LP and a GP?
So we have, it depends on, it can change between deals. So we've seen some that are 20-80 split with GP LP. We've done 75-25 split. So sometimes we'll do a waterfall. Sometimes we'll have preferred different classes of investor. If you put a higher investment amount, you get a little bit more benefits, like a preferred return. So it just depends. We structure them differently. But typically it is an 80-20.
Okay, next question, just bear with me one moment. It says, how often will you communicate or provide updates to investors?
We try to do monthly. So we get the monthly financials, and that gives us an official indication on things. And then so we would communicate monthly. And then typically we do a quarterly call. So it would be like a monthly report sent out, and then a quarterly call where we can get on and talk to everybody and kind of give them the state of what's going on. We try to do a broker's opinion of value quarterly, just to show how the property is doing and recognize any value created. But yeah, definitely at least a monthly report out and a quarterly conference call.
And I'll say I've been through many challenges, and so through those challenging time periods, that's actually when the communication picks up. So we'll have weekly updates in those situations when there's any challenges that we're dealing with. So basically that is, hey, here's what happened, here's what we're doing about it, type of communication. And sometimes it requires an additional investor meeting. That happens too sometimes.
Okay, thank you. I have a couple more questions. It says, what type of insurance do you carry?
General liability, property, and usually there's a couple of riders that will have, depending on the location of the property. I'm not a big fan of doing stuff in coastal markets anymore because of the cost of wind, hail, the cost of just the extra insurance. We currently don't have any properties in Houston either, so there's just extra insurance that you need in those markets. So yeah, it's just typically property, general liability, and then any riders that we need for wind, hail, assault and battery, etc., to keep the property safe.
Yeah, so there's typically the property casualty umbrella and then GL. And then we've also looked at renter's insurance, several properties as well, which is good to have, and also another revenue generating opportunity. It works similar to the bulk internet where you put the property on one policy and you can net a premium per resident.
I forgot about this too. We also have started carrying another insurance. It's just unique. So that type of insurance per unit, that we can make some income on, we call it stern risk or RLL or something similar. So the residents have to, they sign in their lease, there's a minimum coverage that they have. But on top of that, we've started covering deposit insurance. So instead of a resident having to pay 1 month up front, they'd be able to qualify under, say, lease lock is one of the examples we use, where there's a max that they will pay if the resident skips, if they damage the unit, if we have this large cost that we have to incur, they will basically ask for a few things. We turn it in and they send us a check for the repairs and then the skipped rent. So that's another layer of protection that we've started to add.
Okay, great, thank you. Next question is, I think Kaylee, you've mentioned this initially during your opening, but what type of properties and neighborhoods do you specialize in?
Properties, value add, multifamily, neighborhoods that, Joe, you want to cover what kind of demographics we really go for?
So we would look for, we're focusing on Texas and specifically DFW just because of the population growth and the job growth that we're seeing, that it feels more safe of an investment. But typically we look for a median household income. We try to look at the annual rent. What is the average annual rent for the property? And then we multiply that by 3. And we want the median household income within a 1 to 3 mile radius to be above that. So we have room to raise rents, and we're not, and we have an affordable tenant base. So that's something we look for. And then want to make sure it's a low crime area, because that'll be hard. You'll struggle with occupancy if you're in a high crime neighborhood. So those are some of the things we consider when picking a location.
And also job growth, that's another huge important thing. I've seen some smaller markets I've been in that had negative job growth. People are leaving. And so job growth is healthy typically at the type of population size that we look at per, a major market like DFW. 2% year over year is really healthy. So like the project we're working on now is 4% year over year. That definitely qualifies with crime decrease, job growth, median household income, income increase, and median house value increase as well. Also, we want to look at a market stress test wise to make sure that these people that are leasing from us are not going to be trying to buy a house. So one stress test that we ran recently on a project we're working on now was looking at, if I had a 30-year mortgage, if we had the average down payment for someone who's a first-time home buyer, etc., what kind of mortgage payments are they going to be looking at every month, and what is the difference between our average rents and that amount? So we provide ourselves surety in a market where it's workforce housing. So like in this example, their average mortgage cost is a little bit over $2,000 a month with all of the costs involved put into that number. And then if they're renting, they don't have a down payment, of course, and it's about $1,000 average for what we're looking at in this particular DFW market I'm thinking of that qualified under all of our criteria. So we're not concerned with them wanting to leave to go buy a house. So that's another thing that we want to look at too.
Okay, so a comment just came in, not necessarily a question. It says high crime score also affects cost of and availability of insurance. So just something else to factor into.
Too, yeah. People won't work there. I mean, there's a variety of things, yeah.
Okay, so if you have any last minute questions, go ahead and put those in the question box. Great information, both Kaylee and Joe. Let me show my screen. I think that covers all of the questions that came in. Again, if you want to, learn more about self-direction, you want to talk specifically about your, what's going on with you and, how do you want to proceed, definitely, again, feel free to reach out to me. We can schedule a time to talk through it. I have Kaylee's contact information up here. Joe, you also provided your email that was included in the question, the response to the question that came in. Both of you, any last parting words before we end today's webinar?
Yeah, and I think I didn't have permission to send to everyone. It said only to organizers. So maybe if you can copy and share that with everyone.
I did. I responded to the question that was asked. I did include it in there.
For me, I guess the only parting words are really talking about, why we're here. I think everyone that's on this call is familiar or has gotten some level of education with how you can actually use your retirement accounts to invest in real estate tax-free, which is a great tool to use. A lot of people think, like I think we mentioned earlier, that you don't qualify to invest in certain offerings like this because you don't have the cash. But guess what? We can take retirement accounts. So that's something that I want to put out there. And then also one thing that we run into on average is when we have an offering that's available that we can actually have accredited investors, and sometimes we can do offerings that don't require you to be accredited, friends and family, etc. So we have to talk first. Those offerings fill up fast and we don't have very many spots. The law puts a limit on the amount of non-accredited people who are in our deals. So what I've also noticed is when you have a retirement account and you're self-directing, typically best case, it takes about 4 weeks to be able to do the whole process of letting your current custodian know that you want to transfer, getting the funds moved, the hold period accepted, and then you have to fill out your investment documents for our offering and be able to invest with us. So I would definitely recommend that right as soon as we get off this call that you're contacting our wonderful our wonderful host here, Reneika, and asking her how you can start the self-direction process, because a lot of investors, what happens is they wait too long and then they miss out on offerings because they haven't self-directed. So it does take time. So I would definitely recommend to contact Reneika right away after this and get your process going.
Thank you, Kaylee. Yes, you want to proactively get everything set up. No one's going to be a better steward of your money than you, and self-direction is definitely something I obviously highly encourage, most Americans to do. Obviously, you want to do your due diligence. You want to, get your questions answered. So again, feel free to reach out to me. I can answer as many questions about the self-direction process and help you get onboarded once you're ready to proceed. And with that, I'll go ahead and end today's webinar. But again, thank you all so very much for taking the time to join in. Obviously, Kaylee and Joe, again, much appreciated.